You said you believe EBITDA is not a good parameter to value a business. Why is that?
In respect to EBITDA, depreciation is an expense, and it's the worst kind of an expense. We love to talk about float, and float is where we get the money first and we have the expense later. Depreciation is where you spend the money first, and then record the expense later. And it's reverse float, and it's not a good thing. And to have that enter into a multiple, it's much better to buy a business that has, everything else being equal, has no depreciation, because it has essentially no investment in fixed assets and makes X, than it is to buy a company that where there's a lot of depreciation in getting to X. And I may write a little bit more on that next year, just because it's such a mass delusion. And of course, it's in the interest of Wall Street enormously to focus on something called EBITDA, because it results in higher borrowing power, higher valuations, and all of that sort of thing. So it's become very popular in the last 20 years. But it's a very misleading statistic, can be used in very pernicious ways. Charlie, on either one of those subjects?
I think you've understated the horrors of the subject and the disgusting nature of the people that brought that term into the valuation of business. It would be like a leasing broker of real estate you had a 1,000 square foot new suite to be leased, and he says it's got 2,000 feet in it. That's not honorable behavior, and that's the way that term got into common usage. Nobody in his right mind would think that depreciation is not an expense.
Yeah, but it's very much in the interest of Wall Street.
Yes, that's why they did it.
Yeah.
It made the multiple seem lower.
And what's amazing is the way it's accepted, actually. But anyway, it just illustrates how people use language, and sell concepts that work to their own use. And 2 and 20 has the same sort of thing. I mean, the number of people, the amount of money that's overperformed after paying 2 and 20 compared to the expenses that have been incurred, I will assure you, makes for a terrible indictment of that particular arrangement. But as long as it can get sold, it will get sold.
And now they use it in the business schools. Now that is horror squared. I mean, it's bad enough that a bunch of thieves start using a term, but when it gets so common, the business schools copy it. That's not a good result.
Okay.
Warren Buffett criticizes EBITDA as a flawed metric for valuing businesses. He argues that EBITDA ignores depreciation, which is a significant expense because it reflects money spent on fixed assets. This can lead to misleading valuations and inflated borrowing power, benefiting Wall Street while misleading investors. Buffett emphasizes the importance of understanding true expenses and cautions against using such metrics that distort the financial health of a company. His critique highlights the need for more transparent and accurate financial analysis.